The management committee of SBMA decided to have a debate session for the first time in the virtual edition of APPMC 2021. What better topic could we think of other than the hot discussion topic these days, gold versus cryptocurrencies? Honestly, I do not know anything about crypto. I try reading some articles on that, but after 2 lines, it all goes over my head. On the other hand, gold is in my comfort zone. Basis this, gold is my choice. Wait a second. Am I missing something? Is there a better way to look at cryptos? That's the purpose of this session. We have 2 speakers each on gold side and crypto side, arguing out their part of the world. But before that, the chair of the session, Ms. Rhona, head of market analysis EMEA and Asia region StoneX, would give us a broad framework on crypto world. The speakers that would represent gold side are Mr. Adrian Ash, Director of Research from Bullion Vault, and Mr. Nicholas Frappel, Global General Manager, ABC Refinery. Crypto side would be represented by Mr. Charles Morris, CIO at ByteTree Asset Management and founder ByteTree.com, and Mr. Gregor Gregerson, founder Silver Bullion. A brief introduction about the chair of this debate, Ms. Rhona O'Connell. Ms. Rhona has over 30 years experience as commodity analyst, and she is recognized authority in the precious metal sector. She has worked as a metals market analyst in many aspects of the industry, including the mining sector, commodities broking at Rudolph Wolf, where she was a major contributor to Wolf's guide to the LME, and in the equity markets and investment banking, where at Shearson Lehman, she was the group precious metals analyst responsible for advising a wide range of market participants from trading through equities to corporate finance. She has held Excel ranking in the gold sector and has been Association of Mining Analysts, Commodities Analyst of the Year, has been a regular contributor to the media, and has a number of speaking engagement to her name. After a number of years running the GFMS team at Thomson Reuters, she is now the head of market analysis at StoneX, where she is developing a team of analysts to support EMEA and Asia sector in particular. She holds a honor degree in law from the University of Cambridge. I will also briefly introduce the other speaker. Adrian Ash is the Director of Research at Bullion Vault, the physical gold, silver, and platinum market for private sector, now caring for over 3.5 billion of precious metals. Formerly head of editorial at the London's top publisher of private investment advice, he has been trading and writing on precious metals for over 20 years. A frequent contributor to the LBMA Alchemist magazine, Adrian's view are regularly sought by major news outlets from the BBC to Bloomberg, FAZ, Financial Times, Market Watch, and the Wall Street Journal. The second speaker, Mr. Nicholas Frappel, Global General Manager, ABC Refinery, I beg your pardon. He's also an equally experienced veteran. He has utilized many years of his experience in precious metals, both as a trader of spot forward and exchange traded futures, and lately as a marketer to the producers, consumers in the automobile, electronic, petroleum sector, and hedge funds. He manages global ABC Bullion precious metals business out of Sydney and Hong Kong. On the crypto side, Charles Morris is the CIO at ByteTree Asset Management and founder of ByteTree.com, a data platform for digital assets. He has 23 years experience in fund management and has a reputation for actively managed multi-asset absolute return portfolio. Charlie is well known for his experience in gold and Bitcoin, where he has developed notable valuation models. In previous role, Charlie was the head of multi-asset at Atlantic House Fund Management and the head of absolute returns at HSBC Global Asset Management, where he managed 3 billions of assets. Charlie is also the editor of the Fleet Street Letter. The last speaker, Mr. Gregor Gregerson, I just took out this very interesting piece which he has written about himself. His passion in understanding causes and effect within complex system and environment of all kinds. As a native German who has partially grew up in Italy and England, spent 12 years in United States and chose to settle in Singapore, he is fascinated how people are shaped by their environment and how people and necessities shape systems that ultimately determine their environment. With this introduction to all our lovely speakers, over to Ms. Rhona.
Thank you very much, Fatsa. And thank you to everybody who has joined us this morning, this afternoon, good evening. It's a great pleasure to be moderating this panel for you today, and I'm sure that we're going to have a fascinating conversation because we have a stellar lineup of panelists with us. So if I could please have control so that I can share my screen. Hopefully that will come up fairly shortly.
We'll share that.
Can you see it? Yes, good. Well, Vatsa has very kindly given a full introduction to all our, excuse me, all our speakers. There's just one thing that I want to say. In the biography that Charlie sent across to me, he finishes off by saying, while not working, he can be found somewhere in the North Sea. And Charlie, you have to expand on that. What exactly do you mean by being in the North Sea, or is it on the North Sea?
Probably on the North Sea would be more accurate than in the North Sea. I was there yesterday evening enjoying the benefits of the British weather in the summer. I'm often sailing or boating in some capacity.
Excellent, good for you. Thank you for that, Charlie. Right, on to the business. Is my screen still visible to you all? I should have a slide.
No, yes. Your screen is not visible. Would you like us to run the screen?
If you could, that would be great. Thank you. Because I've used the share screen function, but obviously it's not coming up.
We will run the screen.
Okay, that's lovely. Thank you.
Yes, please.
Super. Thank you. So could we move on to the next one? Thank you. This is. I'm just going to set the scene for you, and then let the gentleman do the detailed talking. So yes, thank you. We need to put that up for legal reasons. So now we can move straight through into the first slide. Thank you. Right. This is just to give you a background, predominantly behind the composition of the Bloomberg Galaxy Crypto Index, which is one of the primary benchmarks for looking at how the industry as a whole monitors activity. This was launched in May 2018 and backfilled to August 2017. It's a benchmark basically designed to measure the performance of the largest cryptocurrencies that are traded in US dollars. It's calculated using the Bloomberg crypto price fixings. This is rebalanced and reconstituted on a monthly basis, and the slide that I've got here comes from the start of April 2021, so it's obviously going to be a little different now. The Bloomberg website states that cryptocurrency pricing sources are selected for their liquidity and reliability and approved for use following risk and suitability assessments. And the minimum thresholds for daily trading is a median of more than $1 million. No single constituent is permitted to exceed 40% or contribute under 1% of the index capitalization, and the maximum number of index constituents is limited to the top 12 in terms of market capitalization. It's not deemed a security by the SEC. It works off a minimum of 2 pricing sources that meet Bloomberg's due diligence criteria, which includes at the least anti-money laundering and know your customer policies. And the pricing is free floating, i.e. it's not pegged to the value of any other asset. Each component must meet all of these criteria for a minimum of 3 rebalancings. So this is a key benchmark, obviously dominated by the big 2, Bitcoin and Ethereum. The current market capitalization of all tracked cryptocurrencies is approximately $1.63 trillion. So for such a young asset class, how does this compare with gold, which has thousands of years head start? The value of gold above ground, which give or take is very roughly 199,000 tons. And if you value that at 1855, which is where I did the calculation yesterday, it's rather lower than that today following the Fed, is $11.9 trillion, or 7 times as much as the capitalization of the cryptos. And by no means all of this will ever come back to the market. Perhaps a more realistic comparison would be with investor holdings. So if we take those as the official sector and estimated private investment levels, that comes to just under 80,000 tons, which again at 1855 is $4.7 trillion, or just less than 3 times that of crypto. The Bitcoin market cap is currently in the region of $735 billion, with Ethereum put at just over 285, although there is at least one market observer expecting Ethereum to take over at some point and reach a market cap of roughly 1 trillion, citing its flexibility over banking, real estate, and other asset classes. No time horizon was given, however. Currently, Bitcoin is capped in its issuance. Ethereum, at least thus far, is not. So clearly these assets have been on something of a roller coaster in recent months, and no doubt the fireworks will continue, while gold plays to its strengths as a relatively stable asset with established credibility as a mitigator of risk. So just to set the scene a little further before our panelists go into much greater depth, here are the comparisons of the BGCI and gold against the VIX index. So if we could move to the next slide, please. Thank you. The VIX index, I'm sure everyone in this audience will know, is the Chicago Board Option Exchange Volatility Index. It's a benchmark for market uncertainty based on index options on the S&P 500 equities. The correlation between BGCI and gold is variable. It's in the relatively calm waters of 2018, when gold was drifting lower, the two assets were, while both more or less moving in the same direction, showing little by way of a definable relationship between them. This changed in 2019. Gold started to build a base in the second quarter, aided by increasing concerns over the Sino-US trade war, and this proved to be a springboard for a substantial bull run in the middle of the year, as the US Federal Reserve started its round of rate cuts and gold anticipated those changes. This environment also suited crypto, and although the fully fledged bull market didn't develop until 2020, prices did double between May and July, with the final leg triggered arguably by the first rate cut. Bear in mind that correlation does not equate to direction, but the positive relationship over the year through to the onset of the pandemic is clear. Thereafter, it turned negative as Bitcoin's volatility picked up while gold acted in its usual role as a risk mitigator. So if we could move on to the next one, please. Thank you. This takes us to the BGCI and the VIX. And as you'll hear later in the debate, there is a case to be made for crypto to benefit when the markets are in risk-on mode. So one should expect a negative correlation with VIX for much of the time. And this indeed is what we have. BGCI doubling in Q2 2019 while the S&P was still relatively calm, but nonetheless watching the trans-Pacific geopolitics. Naturally, crypto dipped along with everything else as the pandemic meltdown developed, then staged a solid recovery as markets became more composed before the exponential rise of December through to May this year. And then on to the next. Thank you. We have gold working better through 2019 for the reasons I've looked at, driven by professional money, as the physical market failed to recover after the mid-2019 rally, and then of course falling away almost completely in major consuming nations and the majority of countries in Asia in particular. Gold's role in risk mitigation was amply demonstrated in March 2020. It fell to a 4-month low compared with the S&P, which dropped to a 14-month low, and silver, for example, which fell to a near 11-year low. Then gold took only 4 weeks to recover to the February levels, while a number of other major assets took several months, with the S&P taking 25 weeks and the European Stoxx 600 57 weeks. Crypto, meanwhile, was taking off. So, having set the scene, I will now hand over to Nick, who opens the batting for the gold team. If you have any questions to ask, do feel free to ask them, and we will try and take them as we go through, as well as at the end. Nick, over to you.
Thank you. Let me start again. We often hear about digital gold in connection with Bitcoin. Now, how true is that comparison? Bitcoin has often been related to gold in this way because early adopters sometimes shared a mindset or a worldview that linked gold and Bitcoin as assets that were really untethered from the state, with both considered quite distinct from fiat currencies. You can move on to the next slide, please. There are, however, several similarities between gold and Bitcoin. No liability, counterparty risk, there's no coupon or yield. They move inversely with the dollar, although quite a few assets, of course, do that. And in extremis, gold is DeFi, along with Bitcoin. You can even run without banks or even electricity. Those are some of the characteristics that are shared with Bitcoin and perhaps other cryptocurrencies. However, there are quite a few contrasts that I'll address in a moment. If we can move to the next slide, please. So what's important is that whilst you can draw strong comparisons between the two assets, it's the behavior in response to external impulses or shocks that really define those differences. From a response point of view, gold and Bitcoin appear to be quite distinct. Gold's well recognized as a defensive asset, and it's risk-off in characteristics, with well-researched qualities as a portfolio diversifier. Generally speaking, gold's price performance is best in low or negative real yield environments, especially when the yield environment is combined with low growth. Compared with Bitcoin, asset is an asset with substantially lower volatility, and gold, whilst capable of change in value, still represents a durable, ultra-long-term store of value. Bitcoin may yet be one or all of those things, but by comparison with gold, it can't yet make a similar claim. I'm pretty agnostic on it. The unique attributes of Bitcoin, which I think do give it value, is that it's part of an exceptionally secure network with limited issuance, and that's what might define that claim in the very long run. Can I move to the next slide, please? You can see here, there are many things you could use, but I think this is the best one, that gold's price response to real yields is robust. It's clearly identifiable both visually and statistically as the key explanatory variable for gold price levels in modern times. And if we look at the next slide, basically, I've just reworked it as the reciprocal of the US dollar gold price and real US yields, which gives perhaps a more appealing idea of the relationship between the two. Can move on to the next slide, please. So let's look at some of the contrasts with Bitcoin. It's rather a short history to look at, but we think we can draw some pretty good conclusions. Bitcoin appears to be risk on and appears to be reflationary. And later, when you look at the performance in Q1 of this year, that seems quite clear. Correlated with growth and new economy equities, as it should be really, because you're talking about something which is a disruptor financially, along with other new economy technologies. Bitcoin, unlike gold, works well in a rising yield environment. It's highly volatile. It's probably too early. I think it's too early to talk about a meaningful store of value. One thing that I want to talk about is the alternate use cases. There are very, very many alternate use cases with gold, which sit outside of the gold as an investment asset class. Scalability issues with the hashing rate suggest that Bitcoin would struggle to fulfill a role as a worldwide payment system. And the rightful emphasis on blockchain security means that the scalability trilemma, where you have to sort of weigh off, security and speed of transaction, will probably never ever be solved. So perhaps crypto may have a sort of a reduced impact on that in terms of alternative use cases. Can I move on to the next slide, please? And again, this is actually a comparison here with Bitcoin and real US yields. There's a lot of things going on if you look at the history of Bitcoin and real yields. But the one thing that sort of stands out is the recent price behavior, rising yields, and of course a reflationary move in Q1 of this year, and of course a tremendous positive impact with Bitcoin. It's very different to the response that gold has. It may change and evolve over time, but so far evidence suggests that Bitcoin and gold really behave very differently vis-a-vis rates and risk. Now, contrasting volatility, again, you see the really stark difference between gold and Bitcoin when measured through the prism of 30-day historic vol. This has benefited Bitcoin to the extent that if you can ride out the volatility, of course, you can do extremely well, but it does damage the store of value thesis. I do wonder if Bitcoin's early volatility will diminish gradually over time, but for now, you are looking at two really different investment animals. So the initial conclusion I would say is gold and Bitcoin, sufficiently different that digital coin appears to be perhaps an incorrect comparison. And looking at some of the difficulty that gold, blockchain tokens have had in terms of impact, I think that really speaks to the difference between the two assets. Gold is ageless, it's a durable store of wealth, and it's a good portfolio diversifier. So for me, the best case is really to treat them as different and complementary alternative assets and respect their different strengths. Rather than recycling the cliche of digital gold, it's best to look at the differing behaviors. Thanks very much indeed.
Thank you, Nick. Going off at a slight tangent, when you're talking about the lack of success thus far of the gold blockchain tokens, and I have to say I agree with you on that score, although there is potential. Do you have a view on the potential for the commercial use of blockchain tokens within specific industries? I'm actually thinking about the Norilsk tokens for their, excuse me, for their clients, but I think it's up to 20% of their product, which Norilsk reckons is a way of smoothing out the transactions. And also it means that clients can actually send back some of the material if they're not going to use it. And it saves on all sorts of different things like shipping costs and so on and so forth. And do you think that there is scope for that to take hold?
Yeah, I do, because that's the kind of application where perhaps speed isn't really speed and kind of mass transaction processing isn't necessary. It's a really bespoke way of leveraging off Bitcoin's strengths. And you're really looking at the security element and the irreversibility element rather than relying on mass transactions. So I think that is something that's the sort of use case that could benefit and should benefit.
Okay, great, lovely, thank you. Let's move on, and we'll bring in Gregor Gregerson now, and that's certainly pointed out, excuse me, some of the interesting things that Gregor has defined about his history. Just to wrap up on what Vatsa said, Gregor is the founder of Silver Bullion and its vaulting subsidiary, the Safe House SG, which is upgrading to a new 15,000-ton capacity vault in Singapore. Sadly, I've not seen it yet, but I'm hoping to book my ticket. But I gather from colleagues, not least Martin Huxley, the head of precious metals and the chairman of the SBMA, that it's a very impressive facility. Gregor is also the founder of Cash Pte Limited. So Gregor, over to you to open the score on the part of the cryptocurrencies.
Yep, thank you very much. I trust you can all hear me. If you could go to the next slide, this is my only slide, so I can sort of stay on this one. Thank you very much for the introduction. I was going to say, that we are a precious metal champion ourselves, because our new vault will be able to store about 60% of annual world production of silver, and we have about 15 gold vaults in there as well. So we definitely are physical guys. We definitely are precious metal guys. But we also have a background with Bitcoin, especially. And we did start a company about 5-6 years ago, and we are currently awaiting an MIS license for it. It's looking good. So next week we have some MIS interviews and so on. And what's special about this company is that we developed what I believe to be the first Bitcoin storage, which was actually Lloyd's insured. So we have a method where we physically store these cards, and each card is actually insured by Lloyd's for up to $5 million. And we got that back in '98. We did not develop it much further because we concentrated on cash instead. But that's to give you an idea that we have a pretty long technical background when it comes to crypto and Bitcoin. And that sort of brings me back to this slide. And what I found very important is that, oftentimes when there's discussion between gold and crypto, crypto can mean all kinds of things. And, look at it like the stock market. And you will find that a penny stock is very different from Amazon. So when we use the term crypto, we are lumping it all together, when these tokens or these coins really behave extremely differently. And I think, in the terms of our discussion, really Bitcoin is, I think, what makes the most sense to compare. And within the scope of this discussion, I made this slide to sort of explain some of the key characteristics, at least how I see it, which is the similarities, as was pointed out earlier, between physical gold and Bitcoin, is that they're both decentralized, meaning that you can store it yourself. You don't have counterparty risk. You can give it to somebody else without a central authority being able to block it or otherwise control it. And both of them are finite. I think we all understand that there's only so much gold and silver in the world, only so much is being mined every year. So that's one of the key things that gives it value, the fact that it's rare. Bitcoin is quite similar, and that's a key differentiator with most of the other tokens. Bitcoins, there will only be 21 million of these, and the other reality is about 1/3 of them, or at least 1/4 of them, have pretty much been lost. People have lost the private keys. So really, I think we can talk for an active amount of Bitcoins remaining of about 15 million. So the fact that it is limited, makes it behave differently generally as compared to a token where you can just issue more of them. And so that's kind of what makes Bitcoin and physical gold similar. On the other side of the spectrum, we have centralized type of fiat currency. So basically currencies that are issued by a central source, and typically that would be a government. So we're all very familiar with fiat currencies such as the US dollar and the yuan. And we all know how, especially in the recent years, we've had a lot of new money being printed. And, I went into this business and I got interested in it because I just felt scared that the amount of fiat being issued at some point is going to cross a repetition of what we saw in the Weimar Republic in Germany in 1923, when we had hyperinflation and when a currency sort of basically dies, and reserve currencies typically last about 75 years, and so the US dollar is over 75 years now. So I think over the next decade we're definitely going to find very interesting times, and so that is all compounded with the digital currencies. So we all know about the Chinese yuan. There are other countries trying to do something similar. I think the United States is thinking about a US dollar, and there are pros and cons behind it. But at some point, both of these currencies, these tokens, you have to understand that when we're talking about a blockchain is just a technology name. What matters is who controls the nodes. In the case of Bitcoins, these nodes are quite widely distributed, which is what makes it trustless and decentralized. In the case of a governmental issued coin, the fact that it's blockchain doesn't really have as much implication in that regard, because a government can always increase the amount of coins, and the blockchain is really only a way of making it less likely that the error is happening or that the data cannot be changed retroactively. But it's not a decentralized system in any way, shape, or form. And so, and I think this sort of quadrant basically gives you a good idea of the things to watch throughout the next decade. So that's the physical things, which are old fiat currencies, gold, and then we have the digital, and the digital, the equivalents of these are digital fiat currencies. And then there are coins like Bitcoin. And again, I wouldn't really put other crypto tokens along with it because of the reason mentioned. And so I think with this overview, as we go into the debate and as we take questions from the audience, I think there will be a good sort of background to have to make sure we're all on the same stage. And maybe as a last note, you mentioned cash before. So we are actually looking at combining physical gold and blockchain together into a product called Cash, with a lot of background checks and proof of reserve systems and so on. So we'll see where that goes. But these are interesting times, and there's definitely a lot of things that are going to happen in this sector.
Thank you, Gregor. It's really important to make the distinction between a cryptocurrency and a digital currency. And thank you for doing that, because certainly not necessarily within the professional sphere, but certainly when chatting to friends, I've had quite a few occasions when people have muddled up the two. For example, someone was saying the other day that the Bank of England is going to adopt Bitcoin, which it isn't by any stretch of the imagination. So it is so important to make that distinction. What do you think about El Salvador's recent foray into the sector?
I don't know. I don't know how much of it is blunder or wanting to get some headlines, and how much really is behind it. I think that what we are seeing on a more geopolitical and longer term sense is that countries want to get away from the US dollar, because the US has been increasingly using the US dollar as a political tool. You can see the gas pipeline in Europe, for example, and cases like that. And so there's a big demand for countries to find ways to trade in manners that don't involve the US dollar. And so I think El Salvador kind of going into that direction, or claiming to want to use, Bitcoin and so on, is something that is being watched by a lot of players. And we kind of have to see where that is going. But I think long term, we're definitely going to move to a world where the US dollar is going to lose in importance, and we're moving to alternatives. And maybe what El Salvador is doing is going to be, a bit of a watershed event for that, but it's too early to tell. Or it might just be a blip with, nothing happening behind it. But I look at it in the context of this bigger trend.
Indeed. Well, certainly gold has been a beneficiary of that one over the past 7 or 8 years. It's continuing, particularly with respect to some Eastern European countries, although the fact that Russia has now reached its de facto 20% proportion has taken Russia out of the market as a large-scale buyer, which has obviously reduced the dynamics to some extent. Let us move back directly into the gold scene and pick up with Adrian, who is the Director of Research at Bullion Vault. And Bullion Vault is the online and smartphone precious metals market, now caring for over $4 billion worth of client gold, silver, and platinum. Adrian.
Thanks, Rhona. So the gold crypto debate often comes down to which asset is better. If you look at headlines in the newspapers, on Bloomberg, CNBC, Singapore Times, is gold better than crypto? Is crypto better than gold? I think from what Gregor and Nick have said, we can agree that they are different. So let's take a look at whether crypto is actually a threat to gold. This is often the story, this is often the narrative behind a lot of those headlines, gold versus crypto, is that somehow crypto is coming to eat gold. It will steal some of its investment demand, it will steal some of the dollars which go into gold. So on this slide here, has this happened? Have we seen gold trading volumes fall as a result of crypto's growth since Bitcoin was invented in 2009? Now, the red line shows you Bitcoin trading volumes, daily average. This is a very difficult number to get hold of. I'm not a crypto guy, I'm a gold guy. So I've looked at a variety of exchanges. I've spoken to friends who are in crypto and in tech, and this is as good as we can get for really having some kind of clarity on actually how much is the total volume being traded in Bitcoin on a daily average basis. You can see the big spikes. I think it's interesting that on the data we gathered, the recent spike is not as great as it was back in 2018 in terms of daily trading volumes. But I think what is clear, whatever the problems with the Bitcoin volume data, what is clear from the London LBMA clearing volumes, which is the other line, is that gold has not fallen. Whatever crypto is doing to gold investment and trading volumes, it hasn't diminished the volumes going through the London OTC market. And you can see there a new record spike back in 2020. If we can move on to the next slide, please. So what about gold investment? Has gold investment declined? Have we seen a drop in money going into gold because of Bitcoin? And there's really no relationship for most of the time here, starting in 2015. You have the quarterly price change in Bitcoin in red, and that is on the left axis. And that is against quarterly gold investment demand. Now, the way we've calculated this is that you have net gold investment demand for bar and coin, exchange traded products, ETPs, plus central banks. So this is the investment portion, the very investment portion. Obviously, a lot of jewelry demand is also investment, but this is the specific investment portion. So this is net investment demand. And there's really no relationship between Bitcoin's price moves and the volume of gold investment demand in tons until we get to late 2020, where you may look at this chart and you may say, well, Bitcoin began in Q3, Q4, and then into Q1 of this year, a very, very strong price move. And we have seen a very hard drop in net gold investment demand. Are these two related? I think saying that definitely Bitcoin has eaten gold demand is very difficult. And that's not what I'm trying to do here. But I think if we just click, please, onto the next slide. Thank you. What's important to understand, I think, about the gold market in the last 6 months is that Q4 2020 did see the weakest net gold investment in over 10 years. You had 130-ton outflow from ETFs, but that came after record inflows. You had 1,300 tons of gold going into ETFs worldwide over the previous 18 months. So the 130-ton outflow was relatively small compared to the build that we had had coming into the peak of the gold price last year at $2,000. Putting ETFs aside, central banks, their demand has continued to hold above their 5-year average, and retail investor coin and bar demand has been in line with their 5-year average. Again, we saw this, the outflows from ETFs and relatively stable central bank and coin and bar demand repeated in Q1, but Q2 is looking very much stronger. There will be net inflows at the moment. Let's see what happens to the price today, down at $1,800 again, and what impact that has on ETFs. But we've currently got in net inflows for Q2 in global exchange traded products of around 45 tons. We've seen very strong growth in central banks led by Thailand. And we've seen a good recovery in bar and coin demand as well. Particularly the US Mint has said that it's seen a 3-fold increase in May. Perth Mint numbers were more mixed. Certainly at Bullion Vault, we've seen very strong demand over the last few months. Talking of Bullion Vault, obviously a big issue with Bitcoin is that it's a new technology. It has the appeal of something new, the novel, the innovative, and it is associated with younger investors. That is what people think Bitcoin is strongly appealing for. TikTok investors, as some people refer to them. Are TikTok investors abandoning gold? Are they not coming to gold as they used to? Well, this looks at, on the right-hand axis, you have the value of all Bullion Vault client property, gold, silver, and platinum, now just above $4 billion US. And on the left-hand axis, you have the percentage each year of our new users who are aged under 30. So this is people who were under 30 when they first began using Bullion Vault to buy and trade gold, silver, or platinum. And you can see that when we launched in 2005, we had very few under 30s. We were a very small business. As we grew, that number, that proportion rose to around 16% between 2008, 2017, 18. There was a drop in 2009. Of course, 2009 was global financial crisis, the economic crisis that we had as a result of that. And you saw the percentage of new Bullion Vault users under 30 drop very steeply. We saw it drop again in 2020 and 2021. And of course, this coincides with the steep rise in Bitcoin's price. So again, is there something happening here? Well, if we click to the next slide, please. Thank you. 2020, it saw the proportion of new Bullion Vault users under 30 fall to 13% of all new first-time users. But it's very important to understand that 2020 was a record year for the number of new users on Bullion Vault. And the number of first-time users aged under 30 almost trebled from 2019. So whilst the proportion fell, the actual number rose very steeply. And by the end of May 2021, last month, the number of under 30s opening an account on Bullion Vault this year has already matched 85% of the pre-COVID 5-year average. So under 30s is pretty strong. Final slide from me then. Will crypto work when you need it to? This is the question I think going forwards. We don't know whether crypto will continue to challenge gold in the headlines, in the newspapers. So far, it doesn't appear to be eating gold's lunch, but will it do in the future? Just click on the next slide, please. Thank you. Gold shows zero correlation with US equities over shorter periods. But on a 5-year horizon, when the S&P 500 has traded lower from 5 years before, gold has been higher from 5 years before 98% of the time. And this is weekly data, S&P price index. And the risk of you losing money in the S&P over 5 years is not small. It's happened about 21% of the time over the last 5 decades. And the reason I draw attention to this is because, as Nick and as Gregor have said, Bitcoin, cryptocurrencies offer very much a risk-on trade. And the idea that somehow Bitcoin will challenge, crypto will challenge gold in its role as an investment portfolio and a portfolio asset, I think is clearly missing the point that gold works during extended periods of loss in risk assets. And that I would very much anticipate that gold will continue to show this kind of pattern in the future, and Bitcoin will not. And with that, Rhona, back to you.
Thank you. Thank you very much, Adrian. That's a fascinating presentation. Very interesting about the age distribution. The fact is it seems to be broadly steady, but also from a volume perspective, it looks as if we're looking at an expanding constituency overall.
Very much so, yeah.
Yeah. Right, moving on to our final speaker. We've managed to drag Charlie away from the North Sea to come and talk to us. And Charlie's going to address how gold and Bitcoin can thrive side by side. Charlie, just before you kick off, we've had one question that's come in, which falls perfectly into your lap, whereby the questioner is asking, what is the underlying behind crypto? When someone buys crypto, what are they buying?
Charlie's on mute.
Thank you, Adrian. My apologies. So when people buy crypto, they're buying into a vibrant network. And it's the ability that the larger that network is, the more valuable Bitcoin and crypto in general becomes, because it has more utility, it can be exchanged. If people just bought Bitcoin and did nothing with it forever, if every Bitcoiner just bought Bitcoin and it never moved again, then I don't think it would have very much value at all. And I would like to go back to that simple idea that when Facebook bought WhatsApp back in about 2013 for $18 billion, people thought that was a lot of money at the time. But we now look back and realize that $18 billion to get the world's attention is quite a small number. And so it was a very, very good trade by Facebook indeed. And I think that there's a similarity to what Bitcoin offers. The distribution of the internet, an asset that can be passed around very, very easily. Okay, thank you. So to go back to one point that I think that there's been some excellent points made today. One point that I want to go back to the very beginning is that Bitcoin was created by he, she, or they, known as Satoshi Nakamoto. And Satoshi, he, she, or they, was a gold bug. and very much liked gold and the history of money, and he was very much into the Austrian school arguments. And so when he created Bitcoin, he created a supply that would basically mimic gold over the next century to a large extent. And so the supply side of gold and Bitcoin are virtually the same. Now it's the demand side where they're completely different. So I think that simplifies the conversation to accept the fact that both gold and Bitcoin have got in the future sub 2% new supply year on year. Bitcoin is going to fall faster, but both of them are going to fall. And I think once you're below 2% new supply per year, then actually the supply side becomes less and less relevant as a price dynamic. So it's all about the demand that differentiates these two assets. Now, I just want to mention a few qualitative points of difference, and some of these have been made already, so I'll do this quickly. But gold is established, Bitcoin is a new idea. Gold is static, but Bitcoin is dynamic and can move across the world very, very easily in a secure manner. Gold has an advantage on cost because once gold has been mined and refined, it has very, very little holding costs. Obviously, you have to pay a vaulting fee, but it doesn't require energy. Whereas Bitcoin, the network requires vast amounts of energy, and there's complaints from the environmental, social, and governance people about energy consumption for Bitcoin. Gold's extremely liquid, as Adrian pointed out. Bitcoin less liquid, and that liquidity is cyclical. Gold has typically less than 20% volatility. Bitcoin typically more than 60, sometimes spiking to 100, 150%. It's a very volatile asset indeed. Both of them expect to be hard assets with inflation sensitivity. And I would think that the thing that's really going to drive gold is the portfolio allocation and the easy money environment from central banks. And for Bitcoin, it's the adoption of the technology. Now, it's quite true that Bitcoin could not manage the world's financial system, but Bitcoin, the asset, could provide collateral for modern innovations that could run the world financial system. So whilst it's a long way from assured, the experiment is well underway. And given the price of Bitcoin is quite high compared to a year ago, the sentiment in the market is that that experiment is going quite well. So the utility really for Bitcoin is the potential of its impact on the global financial system. It was mentioned earlier, Rhona mentioned the Norilsk nickel having a token to represent, I presume, platinum or palladium holdings from the company, or nickel perhaps. And the bottom line is that a token enables a very simple and flexible fund structure, one far superior to one today. I was recently asked the question about why people in an index fund like the S&P 500, why the owners can't vote. And if you think how difficult it is for a company's vote to be implemented by an index fund investor, it's basically impossible with the current system. But if the S&P 500 ETF was held on blockchain and we had a system of electronic wallets, it would be very easy for the entire world to be able to vote on corporate governance. That's just one application of the superior payment rails that the blockchain ecosystem offers. Next slide, please. Now, I just want to talk about the last year and the fund flows. Now, it is actually Bytree data. This is on our website if you'd like to see it. It does say Bloomberg. I apologize for that. But what we saw in the first half of last year was the Q1, Q2, Q3 last year was huge amounts of money go into gold. In fact, it was over $40 billion of investment into the ETFs. Now, why did that happen? Now, it's very easy to look at markets and say they're frothy and the world is recovering. But in Q2, Q3 last year, people were genuinely worried that this was a major financial shock that would take a long time to recover from. And so unsurprisingly, there was a huge bid in the gold market. Not only did real interest rates fall because inflation started to pick up, whilst the bond yield stayed very, very low until September, October period. So the economic case was there, but also gold went to a premium, about 25% above my fair value calculation. And so there was a lot of hype in gold. And at that same time, in September, October, people were not interested in Bitcoin. Bitcoin was hovering at $10,000. and the bull run hadn't started. It was only when we had the turn in the bond market, when the risk-on environment started after October, that the money started pouring into Bitcoin, and we had flows going up to $10 billion, which is a lot for Bitcoin, and the money started to come out of gold. And so I think it's a very rational framework that just shows you in the last year how, in the risk-off environment, in Q2, Q3 last year, gold was the big beneficiary, and in the risk-on environment, it went to Bitcoin and obviously other speculative stocks. Slide, please. So this is the framework by which I would suggest it's a simple framework, but essentially when inflation is rising, above the line assets do well, gold and Bitcoin, and bonds and equities tend to prefer low inflation, and then risk on, risk off, which can be summarized by bond yields rising or falling to the right and to the left. So Bitcoin is a hard asset, it's an inflation sensitive asset, and it's risk on. Gold is an inflation sensitive asset that's risk off. And the difference between them is the bond yield. So when it falls, you'd expect gold to do better, and when it rises, you'd expect Bitcoin to get to better. Simply put, equities love it in the bottom right, often called Goldilocks, where we have a low inflation growth environment, and the bond market just likes the strong bid from fear, from low inflation and low growth. Slide, please. And I can illustrate that here, because we've got the Bitcoin price going back to 2013 in black. And I've taken a somewhat unscientific line, the red one, where I've added inflation expectations and the 10-year yield. I've added them together. Now, you don't really normally see that, but you can see, because they're so similar, you see the impact of risk on and risk off environments with clarity. And the risk off environments, from the highs to the lows of the red line, are in red, and the risk on environments with the lows to the highs are in blue. And it's just very obvious to me that Bitcoin does extremely well when the macro tailwinds are behind it, and vice versa. So my final slide, I would just like to highlight the blue line, which is the Byte Bold Index. Now, what we've done here is put Bitcoin and gold together. And the reason why the outcome is really quite so incredible is not just the performance of Bitcoin and gold over time, but it's the fact that they behave in different ways at different times. And so you have a line that's got approximately 26% volatility, with drawdowns no worse than the gold price itself. Now, how do you blend Bitcoin and gold together? Well, we've already talked about this in the presentation with other speakers too, and that's volatility adjustment. And so essentially you want to put the most money into the least volatile asset. And if you do that, and we use a 360-day volatility measure, which is nice and stable, you end up with approximately 20% in Bitcoin and approximately 80% in gold. And that mix really ramps up the returns available from gold, but without materially increasing the risk. And so that's a product that we're very interested in. And please do have a look at the Bold page on our site if you're interested. With that, I'll hand back to Rhona.
Fabulous. Thanks very much, Charlie. We've had quite a few questions, so I'm going to throw all of these open to everybody. Excuse me. There's one which dovetails beautifully with what Charlie and Gregor have been talking about. And this is, excuse me, this is as follows. Can we expect lots more cryptocurrencies that can be a medium of exchange and stores of value that are tied to gold and silver and authenticated by digital ownership? In this sense, cryptos backed by gold and silver, where proof of title was represented on the distributed blockchain. Don't know who'd like to take that one first.
Well, maybe if I can. I mean, so that's pretty much what we are building with cash. There's another presentation coming, after this, where we're discussing a little bit about cash. But we in the case of cash, we're essentially taking an Ethereum-based token, which is similar to Ethereum, which is compatible with all of these wallets. And we are backing it through an asset tracking system, which we developed called CramChain, which itself is using blockchain in order to make sure events are being handled. And such system is actually Right now it's implemented in Loomis Zurich, in Loomis Singapore, in Dallas with IDS, and of course our own vault is using it as well. So we are slowly putting into more and more vaults worldwide. And as you put in a gold bar, that system essentially says, okay, here's a gold bar, it is the real thing, and it is authenticated in other events and so on. So we went through all of that, creating that connection between the physical world, the physical asset, and the token. And in crypto speak, that's called an oracle. And we basically put a lot of effort into making sure that we cannot cheat and that the system is a standard that can be implemented by third parties. So that's very much what we're trying to build. And you can find a lot of information on that. What we are seeing from a demand side is oftentimes people don't have a lot of patience to understand the differences between, let's say, well-developed system and a system that was just put together in a month and sort of thrown out there. And so you sort of have to put in some effort to understand how these tokens work and what makes for a credible system, what doesn't make for a credible system. To give you an idea, with our cash token right now, it's being traded in 3 or 4 exchanges. On some of them, we have $50 million trading volume per month, so it's starting to move up. And people can take delivery of it all over the world. So we are trying to do that. There are 2 other systems out there which are being traded right now. One is Paxos Gold, and another one is Tether Gold. And these are the ones that have taken a little bit of prominence. So there are basically 3 tokens out there which are sort of trying to compete in the open market, with us being the other one.
Lovely. Thank you, Gregor. There's one come in specifically about gold, which says, in fact, it says, hi, Adrian, but Nick, do feel free to chime in. The volumes on a relative basis are significant, as it is just 100 million investors and not many trading there yet. Gold, gentlemen?
Yeah, I mean, I think the slide that I put up showing Bitcoin volumes against gold volumes, the Bitcoin volume, I don't disagree. I mean, the thing has come, well, okay, it's 12 years old now, so it's growing up. It's heading for being a teenager. But my point isn't so much about the Bitcoin volume, which has clearly grown, very lumpy, very spiky, but is clearly moving higher over time. My point really is about the gold volume, which has not suffered. And it is this debate about crypto versus gold, Bitcoin versus gold, that I really want to just draw attention to. And I think that gold's continued growth, in line with monetary inflation, of course, in line with a growing global economy where there is more money and more people are now able to enter the gold market, whether as jewelry consumers or as private investors. But nonetheless, gold has not lost, it has not shrunk as a market alongside the growth in Bitcoin. Nick, I don't know if you have any comments on that.
No, I mean, I think that's almost all it. And I think that volumes will remain robust because I think that the environment that gold exists in is still, fundamentally a positive one. If you look at one of the comments made by the previous speaker, Sin Beng Ong, he talked about the average inflation targeting policy of the Fed. And I tend to agree that I think that will mean an environment where real yields can be lower for longer, and that's good for gold. And then speaking to something that you mentioned, which is about the performance of gold vis-a-vis the S&P. The S&P is an incredible decade, or a long period of high performance. That if there's a reversionary sort of decade, then that too would suggest that gold will have a bid there, and that will keep volumes high.
Thank you, gentlemen. I guess this was inevitable. We've had 2 questions on the same subject. I'll only read one of them because they're pretty much saying the same thing. Do you think Bitcoin price is being manipulated by some celebrities? In the past months, sometimes several words on Twitter triggered emotion of the market. How can investors manage this risk? Well, I don't expect anybody to actually point the finger at anybody else in this one. Otherwise, we could end up in trouble. But certainly, investors' risk management, I think, is something that we could address.
I think it's perfectly okay to discuss Elon Musk in public.
Okay, fair enough.
I mean, he has come to the space in late January, and just by changing his Twitter handle to #Bitcoin, with 50 million followers, that just caused mayhem in the market. And it changed the behavior. We had a very different behavior in the Bitcoin market from February to April. And he also managed to send the price of Dogecoin, which is deemed to be basically worthless by people in the space, sky high, to a valuation of over $50 billion at one point. And so it is extraordinary what celebrities can achieve. But I think it's also the macroeconomic environment that we're living in. And when we look at stocks, like, things like GameStop, which is still trading over $200, I think we have to bear that in mind, that the manipulation goes way beyond Mr. Tesla.
Absolutely. We've manipulated our time perfectly, gentlemen. We are bang on the end of our session. So thank you so much for all your time and expertise and your willingness to come and present and take questions from the floor. Many thanks indeed. That's her.
Thank you so much. That was indeed quite a debate. Various aspects of crypto clearly outlined, and the role for gold and crypto is also very clearly articulated. I personally learned a lot of new information about gold and a broad framework to understand the esoteric world of cryptos. Thank you so much for all our panelists, Mr. Adrian Ash, Mr. Nicholas Frippel, Mr. Charlie Morris, and Mr. Gregor Gregerson. Special thanks to Ms. Rhona. I must mention that she has put in so much of time and efforts behind the debate, just to ensure that the team delivers really useful insights for all of us. Thank you so much, ma'am. We really appreciate all your efforts. Thank you very much.
It's a great pleasure. Thank you.